Today we're talking mean reversion profitability in non-dollar pairs. So Frank and I earlier this week were looking at some cross currency pairs not having a dollar component in it because they were the biggest movers of the day. I think Monday coming into the weekend, not a lot of dollar news, and so got my gears turning about looking into these non-dollar pairs and continuing on to a similar study that we did in dollar pairs, but with the thesis of we're in summer, not a ton going on unless you have, the intermittent Trump-Powell back and forth to fire or not to fire, the world's fastest taco trade, as I was calling it yesterday. With all of that volatility. But FX markets, not the most volatile right now, and non-dollar pairs are a part of that as well. And so we're working with the thesis that in low volatility, without major movers, FX markets are more prone to just go back and forth, trade back and forth within ranges, and perhaps exhibit more mean reverting qualities. We'll test if that's true, which pairs it's true for, and when a trade like that would be the most profitable. But here we're looking at the 7 most popular non-dollar pairs here. So a lot of these still highly liquid, still highly traded across the globe. And so here in the US, we tend to have a very U.S. dollar oriented lens, and for some good reason. I mean, it's the most traded currency in the world, and a lot of major countries and regions trade a lot of things in dollars, and so it's no surprise. But it's also worth calling out that a lot of these other currencies, these currency crosses, can be just as liquid at times, especially pairs like that euro yen and pound yen, the most liquid non-dollar pairs, I believe, by some recent statistic. But here we're looking at realized volatility annualized over the past year, and also the percentile in which what we're looking at, the realized volatility we're looking at currently, how that stacks up to the past year of data. So not only are we seeing volatility, in the 3% to the near 7%. To contextualize that, in all except that Australian dollar, New Zealand dollar, and that euro pound, except for those which are in the middle of their range, the others are very low in the percentile column, and this low vol column analyzes if this percentile is under 30, the 30th percentile, or not, and that's how we're going to measure, our low volatility environment. So we're seeing 5 out of the 7 pairs in this low volatility environment. Any surprises to you here, Mike? I know I pulled these numbers, threw them right at you.
NZD, the Aussie is kind of an interesting one there because that surprises me. I watched that chart a ton, and it's got a lot of back and forth, so that's interesting to see over the past 5 years. I mean, 5 years ago I was 20 years old, so maybe I wasn't looking then, but lately that data surprises me, just comparing that to chart data.
And yeah, we're going to see some interesting trends across this data, but worth calling out on this slide that you see the Australian dollar, New Zealand dollar at 3% realized volatility. You see the euro pound at 4.5% volatility. Those don't scream to me as high volatility percentages, but those are in the middle of the range for these. And the more you think about it, the more it starts to make sense that pairs like currencies like Australian dollar and New Zealand dollar have a rolling correlation with each other of near 80% over the past 5 years, and that euro and the pound similarly have a very close geographic proximity and a very high historic correlation. So it makes sense that you wouldn't expect these to fluctuate a ton. At least that's how I'm contextualizing it. But let's get into what we analyzed. We analyzed the past 5 years of price data from July 2020 to July 2025 using daily close data for these 7 non-US dollar pairs. And what we did, we measured the realized volatility, as we just brought up, using 20-day periods, standard deviations, and we separated this into low volatility environments, less than the 30th percentile, and the rest high volatility. So not an equal weighting, but since this volatility is a little harder to measure, splitting it 50-50 didn't make a ton of sense to me. Just identifying when you can recognize that volatility is definitely coming in. It's likely to be in that 30th percentile or lower. And what we did is we used Bollinger Bands to simulate trade performance. So what we did is trade entry criteria would be when the closing price touched the 2 standard deviation Bollinger Band, then we entered a contrarian trade. So when the price was less than the lower band, that triggered a buy and going long. And when the price got higher than the upper band, that triggered a short trade to simulate, a mean reverting trade. And what we did is we calculated the win rate, so any positive P&L, with various time frames, so 1 to 10 days, and compared a lot of these volatility environments and the win rates there. The reason we use Bollinger Bands is because that is actually a pretty straightforward calculation using the moving average as well as the same standard deviation on a rolling basis. So it reacts to volatility environments. So when we're talking about low volatility and high volatility environments, this indicator or calculation works because it reacts to, it's not a set threshold across the board, a set pip distance or percentage distance. It reacts to how much the market is moving. And we got some very interesting results here. First, we're looking at chopping it between low volatility average win rate and high volatility average win rate to see if this thesis was true. When we did this with dollar pairs, it was a bit of a mixed bag in terms of which environment was better for mean reversion. Here, non-dollar pairs, it's looking a lot more favorable for low volatility mean reversion, as well as mean reversion across the board. I mean, I ran these numbers a few times to try and get this, make sure this 71% win rate was right. And this study that we conducted has a very specific set of criteria. The occurrences, weren't small, but they weren't a ton by any means. We're looking over past 5 years of price data, and for certain pairs that meant only 200 trades entered, and so not a ton of opportunities. But when we're looking at these numbers, definitely favorable historically for mean reversion, and as much as almost 12% pop in euro yen for win rate in low volatility environments compared to high volatility environments. Anything here that piques your interest, Mike?
70, anything 50+% win rate is pretty crazy, right? Because if you judge your risk reward right, you can be profitable with a sub 50% win rate. So a 71.6% win rate that's surprising to me. It makes sense because if you just watch forex charts a lot of the time, you see the mean reversion happen a lot, right? But a 71.6% win rate on a strategy is pretty crazy.
Yeah, and who knows if that would hold up, into this current environment, just looking at historic data here. But yeah, what sticks out to me is, validation that, maybe the US dollar component in a lot of pairs, popular forex pairs, can be a much heavier impact causing sustained swings, as we've seen in the gigantic depreciation of the US dollar so far this year, on the heels of a massive appreciation heading into 2025. So definitely some expanded ranges in dollar pairs. Another thing that sticks out to me, yen markets, when we look at dollar yen, that I've cut this up of fair 4 or 5 different ways, doing, mean reversion versus momentum trading, various historic studies. Yen pairs consistently don't exhibit, the dollar yen, that is, doesn't traditionally exhibit as solid mean reversion characteristics, whereas here we're looking at Australian dollar yen, euro yen, pound yen, still posting higher than 50% win rates. And very interesting to me that euro yen has such a pop in low volatility. When things aren't moving, that tends to mean revert, because we're looking at euro yen and pound yen, I think, still near historic extremes. We'll have in the platform after, but those have been trending recently. So maybe some potential opportunity there. Last thing I want to call out that caused me to rerun a bunch of these numbers was the difference in Australian dollar, Canadian dollar, and New Zealand dollar, Canadian dollar. Two very highly correlated currencies against the same currency, two highly correlated pairs. How on earth is there's such a drastic difference between their win rates in this using this criteria, with New Zealand dollar, Canadian dollar not being profitable really in either environment, and such consistently for the Australian dollar, Canadian dollar, Aussie CAD. And the second tier analysis I did was calculate the overlap for when these extremes were hit, and it was only 35% overlap between these two occurrences, meaning these Bollinger Band triggers only happened on the same day for these two pairs 35% of the time. And so you were getting majority of unique instances, unique trade entries between these two pairs. So that validated that result. But yeah, let's get into timing these trades, because when we think about forex markets, it's very popular to intraday scalp, but also because of the kind of rolling nature of the contracts, you don't have to decide a month like futures. You could theoretically hold on to these positions for as long as you'd like. And so what actually works for mean reverting strategies? Here we're looking at low volatility environments. Frank Caberna hates when I throw up 10 million numbers on the chart. And so I've made it into a nice little graph, nice little visual representation. And this is just the win rate by time held in days. So looking at hold periods from 1 day to 10 days. And, we're seeing what we saw in the table with Australian dollar, Canadian dollar outperforming the rest. And I highlighted, the sub 50% here in red as what wouldn't be, with symmetric risk reward, what wouldn't be profitable. And we're seeing, consistency by pair, pair characteristics taking over here. But was surprised to see that for more than 3 pairs, around 6 days held was the peak for win rates, peak for our top outperformer, peak for euro yen, and I think the Australian yen. So this calls out to me that there isn't a ton of a clear winner for hold it this many days, but there is merit to holding perhaps multiple days, and as much as more than a traditional trading week. Anything else here stick out to you?
Just when you look at Aussie CAD and NZD CAD, just that it looks like the charts are inverse of each other, which is pretty interesting. Most simply, what this data is kind of showing me is Aussie CAD is, again, past performance is not indicative of future results, but Aussie CAD is things are kind of already priced in, right? And that's why things mean revert so often, or at least that's what the data is saying. NZD CAD or Kiwi CAD it's not really priced in yet, right? Things change and the market's not mean reverting as much. That's just a surprising factor there. I'm gonna probably take a look deeper into this after, because that's really interesting to me, the differential between such correlated markets.
Yeah, to me as well. And now looking over high volatility environments, so when volatility is in the upper 70 percentile, so taking out that lower third just about, you're seeing a lot more consistency, not only the win rates coming in across the pairs, but really just pair specific. But the one trend to me that stuck out here was the difference between day one and day two, an uptick in a lot of these pairs, particularly Euro Pound and Aussie New Zealand dollar. So all this saying to me, maybe it's worth waiting more than a day if you're already waiting one day for this mean reversion if you don't get it the first day. So not a ton of takeaways from these charts itself, but a bunch of key takeaways that I hadn't known prior to this study, and that non-US dollar pairs generally more mean reverting in low volatility environments. We saw that in 5 of the 7 pairs, and greater than 50% win rates in a lot of those using this trade entry criteria. Australian dollar, Canadian dollar becomes the outperformer in this group, posting as much as 70+% win rates for some of these trade criterias. And regardless of low volatility environment, high volatility, some of these mean reversion trades can take multiple days for greatest success.